today I'm going to run through one of the big issue in the investment world at the moment, and not even in the investment world, but for nearly everyone who has to buy food and goods and energy to live, is inflation. And inflation has really changed the picture of the world and the economy and investments from where we were in the last decade. So we'll run through a little bit of why we think we're seeing inflation, why we think that inflation may unfortunately remain over the next decade, and then what does that mean? How does that change the outlook for house prices, for wages, for investments in equities and other assets? So just before we get there, a little update on Milford. We're one of the leading investment firms in New Zealand, a team of 40. Most of us are owners in the firm, so we have good alignment with our investors, like you as part of PWA, and that we invest our money alongside you. So big alignment of interest there. So kicking into it, and please, ask questions or type them in along the way. Jack, don't hesitate to button and clarify any points I'm making, or hurry me along to something of more interest if it comes up. But we'll go through now structural inflation. So at the moment, we saw inflation appear during COVID, when initially that inflation appeared because supply chains were impacted during COVID. So businesses were shut down in China and around the world, and we couldn't import those goods, which meant the cost of those goods went up. That inflation then transitioned into something that was more demand-led, and that governments around the world, and nearly every government in the world, gave so much money to their populations to support them through COVID, and central banks lowered interest rates so much that borrow money was very cheap, and it created this huge demand boom. So the inflation transitioned more into that we were simply just consuming too much. A lot of countries around the world were consuming 20% more than what they were in 2019, and supply chains just could not react to that huge and unexpected sudden increase in demand. So we saw the price of motor vehicles and nearly every other good go higher. And then, of course, earlier this year, we had the next kind of impact on inflation, which was the beginning of the war in Russia, Ukraine, and that caused all sorts of shortages in energy, oil, gas, and that's caused a huge amount of inflation in Europe, driven by high energy prices. But that inflation becomes sort of global, because Europe is trying to import gas from the rest of the world. They're trying to import oil from the rest of the world. They're buying coal from Australia, and it's pushed up energy prices largely around the world. So these inflation impacts, to an extent, are temporary, but what we believe has happened at the moment is COVID and the war with Ukraine and Russia has fast forwarded a return of more structural inflation. So that's what I want to focus on today, is why elements of inflation we believe will carry on going forward. So I'll start going through this now. This is a little bit of a historical look back on inflation, and just to be clear, when we're talking inflation, we're talking the year-on-year increase in consumer goods. So it's the basket of goods that consumers tend to consume. It includes petrol prices, food prices at the supermarket, restaurant prices, airfares, motor vehicles, everything that we buy on a daily basis. So inflation peaked in the 1980s at 20% year on year. So we had, I'm sure many of you were around then and remember that episode. I wasn't actually born then, but it took off. It sort of began with the oil crisis in the Middle East, where the Middle East stopped exporting oil and constrained the oil supplies. We then had droughts in Brazil, and it really just took momentum and got quite out of control through the 1970s, until in early 1980, a new Federal Reserve chairman in the US called Paul Volcker put interest rates well up, so interest rates are in the orange line here, and inflation is the blue line. But he put interest rates up over 20% and inflation in the blue eventually came down. And you know, that's where we, of course, we all get the stories where the young millennials here will complain about how much how big a mortgage they need or the cost of a house, and of course the older generation will point out that they had to pay, correctly so, we're paying mortgage rates over 20% to buy a house back in the 1980s, which is much cheaper now. But after the 1980s, you know, inflation really did come down, and as inflation was under control, it allowed the policymakers in the US, but also around the world, in New Zealand, Australia, to consistently lower interest rates every time there was an economic crisis. So, you know, you had small recessions, they'd cut interest rates, they'd increase them a little bit as the economy improved, but then they'd chop them down lower again as the economy weakened. And you just had this 3-4 decade long era of lower and lower interest rates. And that now has begun to change, because as you can see, the blue line of inflation here, this is US inflation, but it's not so different to New Zealand, is shot up to 8% year on year, which is a high since the 1980s. So going through, you know, what did this cause? Well, New Zealand, over this period since 1992, New Zealand house prices went up 8-fold. So a 9,000% gain basically over that period. You know, in recent times, we supercharged even that. House prices in Auckland went up 46% since COVID began to their peak in November last year. They've since pulled back 16, but that 46% increase was absolutely, it was sensational. Sydney prices went up 24% over that period, which is considered a big move, but 46% in New Zealand was, and in Auckland, was quite outstanding. So, you know, we've had a situation, and I've got a few different time periods here, but since 1991 to December 2019, that 30-year period, house prices up 800%, which is 7% per annum. And wages have only gone up 1.8% over that period. And you can see that, you know, over all these decades, wages have really gone up 2% per annum over the whole time, while house prices have gone up near just under 10% per annum over all of these time periods. So, you know, how do you get house prices go up so much when wages only go up 2%? And in theory, in a world of the cost of debt or a mortgage, or your ability to get a mortgage is the same, your house prices should largely go up at a similar amount to wages. And of course, you know, strong immigration in New Zealand and you know, a little bit of a lack of supply of housing has contributed to house prices going up more than wages. But the real reason you can have house prices outstrip wage growth is largely because mortgage rates just keep going lower. So, and the red line here is the 2-year fixed New Zealand mortgage rate. Most people in New Zealand have tended to be borrowing at 1 or 2 years for their mortgage rates. You know, in 2000 it was 9%, and you know, in the economic boom ahead of the financial crisis in 2008 is around there. But they have largely trended down. You know, if we went back to 1980, of course, these mortgage rates would be over 20%, as we know. But mortgage rates have just trended down all the way to you hit just over 3%, or in some cases, a lot of people were getting shorter dated loans around 2.5% in mid last year or early last year. So as mortgage rates went down, then the bank will give you a bigger mortgage because you can afford to service a bigger mortgage. And when you can do that, you tend to pay more for your house price. So it really drove this sensational boom. And of course, if mortgage rates reverse, which they are at the moment, you're now having to pay over 5% for a 2-year mortgage, then you can't afford to service the mortgage you may require to pay for a higher house price, which is why, of course, you're seeing house prices now coming down. So house prices, there's obviously other drivers, including immigration and supply of housing, but, you know, the single most important driver for house prices is your mortgage rates. And the biggest driver of what your mortgage rates are is what is inflation doing and what kind of interest rate do central banks the RBNZ in New Zealand or the Federal Reserve in the US need to set those interest rates in order to control inflation. So, which brings us to the single most important topic in the investment world, is what is driving inflation and what is the outlook going forward. So in the previous 3 decades, we've had a lot of deflationary drivers or drivers that reduced the rate of inflation that allowed us to lower those interest rates. And I won't go through the slide in detail now because I bring it up again later. But a lot of these drivers have turned into headwinds or will be more inflationary going forward. And I'm going to go through these sort of briefly one by one to cover it off. So what drove this reduction in inflation over the last 3 decades? Well, the first one is the demographics in the West. So inflation, which is the orange line here, as we showed earlier, peaked in 1980. At that time, the average baby boomer was 25 years old. So they were coming into the workforce, or they'd finished tertiary education for the ones that did that. But you really had, by that point, the full scope of baby boomers, the 12-year kind of period of that baby boom. Most of that age group had joined the workforce. And that created a big increase in the supply of labor. When labor supply is abundant, well, there's plenty of people there looking for jobs. Of course, companies don't need to pay people as much for those jobs. And that meant that wage growth began to slow. And when wage growth slows, you tend to find inflation is a little bit cooler, because if people aren't getting good increases in their wages and they can't afford to buy goods, that become more expensive. So inflation is very tied to the level of wage or salary increases. And bringing on the baby boomers, a very productive and large workforce into the Western world, put a really cooled off wage growth and inflation. At a similar time, of course, we had more and more females beginning to enter the workforce. So the right-hand chart here shows that in 1919, we only had 41% female participation in the workforce, and that really has increased up to 45%. So again, we brought in a lot more workers who weren't there in the earlier periods. The second big driver of inflation has been globalization. So my father used to be one of the owners of a furniture manufacturer called John Young Furniture. I don't know if some of you remember it, but it was one of the larger manufacturers of furniture in New Zealand, aimed more at the middle class and slightly to the upper end. But they used to employ nearly 200 workers in Mangere Bridge and manufacture all the furniture there. And of course, free trade came along. New Zealand signed a free trade agreement with China, and then all of a sudden very cheap furniture came in from China, and you just couldn't compete with the cost of labor in New Zealand, the cost of manufacture furniture in New Zealand versus very cheap labor in China. They eventually stopped manufacturing and became an import operation. So they sacked 195 employees, and they kept 5 employees to run an import operation. And of course, those 195 employees all of a sudden needed to find a job elsewhere. At the same time, many manufacturers were closing down, and other people were looking for jobs. So it brought down that wage growth in New Zealand again, and created more oversupply of labor. But in the 1990s, China really opened up to the world. They said that we want to become part of the Western world. We will urbanize, we'll bring all these workers from rural populations and bring them to the cities and get them working in manufactories. And over the last 3 decades, China has relocated 500 million people from rural locations to cities, and they've effectively increased the global workforce by 500 million. And that allowed China to build huge amounts of much cheaper goods over there. And it meant that we could buy cheaper goods from China. At the same time, the fall of the Berlin Wall and the Soviet Union meant that effectively 200 million Eastern Europeans also, in a similar kind of vein, effectively became part of the Western world as opposed to the Soviet Union, and they began building manufactories and exporting cheap goods. So this really brought down the cost of goods and imported goods, and it created an abundance of labor in the world and in the Western world that cooled inflation. Technology has been a deflationary driver. It has been since the beginning of time. Every time a new technology is discovered, whether it's discovering how to use a hoe in farming back pre-BC, prehistoric times versus computing and the internet in recent times, it makes us more productive and helps to bring down the cost of producing goods and services and make it lower. So that's continued to be deflationary over recent years. The third one I haven't touched on, but cheap commodities were part of lower inflation over recent years. So importantly, as has been very topical this year, Europe benefited immensely from the export of cheap Russian gas to Europe. So that means we could build all these BMWs and Mercedes-Benz using cheap electricity and gas from Russia. That allowed a huge manufacturing industry in Europe and Germany in particular. And now that Russian gas is being constrained as a result of the war, and the cost of gas and energy and electricity in Europe has gone up over tenfold, means that all of a sudden those BMWs and those Mercedes won't be as cheap if they're still going to produce them, and of course every other good that's produced there. So that of course helped keep goods lower as well. An impact is, what did this all mean? In the orange line here is the prices of durable goods, so furniture and TVs and refrigerators and microwaves. Durable goods are actually cheaper today than they were in the early 90s. So they've actually gone backwards, a lot of them. Why non-durable goods like food and perishables, which can't be manufactured as easily in China and exported, have gone up. And services, which is like your tourism and other industries and restaurants, of course, you can't import that at all. It has to be supplied domestically. So the cost of services have gone up more than goods, because we can't export that to cheaper countries overseas as easily. Now, moving forward, is why do we think that some of these big drivers have changed, and what's going on in the world? And really, these big trends we're talking about, globalization and age demographics, these are sort of inevitable forces that would have changed over the coming decade or 2 decades anyway. But the combination of COVID and the war in Russia really accelerated a turning point in these trends. So when it comes to globalization, well, we got a pretty stark reminder during COVID that we are a little bit vulnerable. Many countries in the West and around the world, including New Zealand, being completely reliant on key goods being imported from certain countries or overseas. Because when a crisis hits, some of those countries may decide that they need to keep all those goods to themselves and to look after their own population rather than export it overseas. So COVID was the first warning shot that the world may now be too globalized and too reliant on foreign countries and foreign supply chains to support themselves. And then an even bigger impact was, of course, when Russia invaded Ukraine, and countries responded by trying to sanction Russian goods and ban the import of Russian goods, and Europe realized that they've really got themselves in a pickle with 30 to 40% of their gas consumption coming from Russia, and no way to replace it in the near term, which has caused electricity prices to go up tenfold in much of Europe. The problem with being completely reliant, and the problem goes both ways. It's also Russia and China are very nervous being reliant on the import of any necessary goods in the Western world, because they are worried, Russia's already been sanctioned, but China is worried that one day the Western world may ban the export of certain goods to them. And that is beginning. The US has already banned exporting high-grade computer chips to China. So NVIDIA and other companies that make these high-grade computing inputs can no longer export to China. And China can't replace that at the moment domestically. So the world really is preparing, both the Western world and the Eastern world are both preparing to have supply chains that aren't as dependent on trade partners. So what we're going to do on that is New Zealand and the US and Australia and the UK and the Western world are going to be building more manufactories back either home, which we call onshoring, or in friendly countries, which we call friendshoring. So, and governments and policymakers are beginning to put in policies to support this. So there's been, big support for computer chip manufacturing in the US. The UK, for example, is incentivizing battery manufacturing in the UK so that the electric vehicle industry won't be reliant on Chinese imports. So this sort of reversal of globalization and the building of goods back home for a safety perspective is more inflationary because the cost of these goods are going to be higher. So unfortunately, it means that we may have to continue paying more for these goods over the next decade or two. But the positive side of it is it's going to create more jobs back in the West, which means wage growth will go up. As I mentioned earlier, though, when wage growth is higher, it tends to lead to higher inflation because with higher wages, people can afford to pay more for their goods. The demographics in the West is in 2020, the median baby boomer turned 65. So we said inflation peaked in 1980 when the median baby boomer was 25. Well, of course, 40 years later, the median baby boomer is approaching retirement age, which means some of the baby boomers, of course, are just over 70 and further into that age where they may have retired. So we're now, this orange bar here shows the current demographics in developed worlds, and this is the number of people at each age bracket. So you can see the baby boom is here and the years afterwards, but the big surge in population was beginning with the baby boomers at turning 65, and it actually tails off a little bit after that to the 24-year-olds. We're in a situation now where we have more people approaching retirement and a very productive, experienced workforce, and the baby boomers approaching retirement and beginning to retire. And we don't have as many young people coming on beyond that, and many will say the millennials are nowhere near as productive as the baby boomers, and they're probably right. So yeah, you've got this situation where labour supply in the Western world will become more constrained, just as we have more people retiring versus less people entering the workforce. And COVID accelerated this a bit. Some of course, people near retirement age when COVID began and said, you know what, I've got enough money for my retirement. I think it's time I moved to that retirement stage. And, particularly in the US, we saw that happen a lot, but also back in Australia and New Zealand. In the Eastern world, we've had the big benefit from that 500 million people from China coming on to the global workforce. There is a little bit more to come, but it's nowhere near the extent of the impulse of this huge workforce that came from China and Eastern Europe over the past 3 decades. Going forward, it's hard for India and Africa. India and Africa are the big populations that could come onto the global workforce. It's very difficult for those countries to repeat what China did. China really was incredible how they managed to relocate so many people over that period of time. An autocratic government with full control can kind of do it easier than trying to coordinate 50 different African countries, or India, who has always struggled to really achieve what China has done with the modernizing their economy. So, possibly India get their act together and bring on a lot of workers. Possibly a couple of African nations do it, but it's going to be near impossible to repeat the size of the workforce coming from the developing world as what China did over the last 3 decades. So we suspect that you're not going to find that it's easy to outsource goods to new countries as what we've just gone through in the period. Commodities around the world remained more scarce. This is the dollars of investment spent in mining on the left and in energy projects, so oil or gas on the right. And it really has been much lower in the previous 5 5-7 years versus what it was back in the earlier 2000s, and likewise, especially with oil. People are reluctant to sign off on big new oil and gas projects, given that in 20 or 30 years, we won't need anywhere near as much oil as we do today. So, even with the shortages we're seeing at the moment, there's not a big response in terms of companies wanting to build new oil projects. We spent 5 years criminalizing oil companies or investors who invested in oil, saying that it's bad for the economy, and of course it worked. People stopped building new energy, and now we've ended up short. So governments may actually have to go and help incentivize or do it themselves to bring on various energy projects to secure supply. But we are going to be facing a world for the next 5, 7, 8 years until we greenify the economy. We will be a little bit short energy over the next decade. And of course, one of the good positives out of the recent events this year is it will accelerate this green investment that eventually will improve supply, but it's going to take some time to do it. I just got a question here, which I'll tackle now because I'm on top of it. I'm reading the question there as well, Jack. So there's a question that most of the demographic and economic trends being discussed, apart from the Ukraine war, have been visible and increasingly predictable for quite some time, which I agree with. You're 100% correct. And why were we not seeing the impact and higher inflationary projections earlier? So it's a very good question. So yes, no, these demographics are visible. Deglobalization was probably visible. COVID kind of accelerated a lot of these things. So to an extent, it really accelerated deglobalization. I think deglobalization was largely inevitable to occur as the US, who's been the superpower of the world since, largely since the end of World War II, and there hasn't been any other power there to rival them. With the rise of China and another superpower, you get the repeat of Japan and Germany rivaling the UK and Britain back in the early 1900s. So anytime you get two superpowers rivaling each other, they become afraid of each other and mistrusting of each other, and it starts to cause global tensions. And we're in that. We're heading to that environment now, where China's military gap with the US is closing, and the economic gap was basically closed with the US. So one way or another, I think the kind of global deglobalization tensions were going to come to a head in the next 10 years. But the war with Russia and Ukraine just accelerated it. It brought forward those tensions to today. And that's caused a pretty big reaction and policymakers starting to get plans ready to deglobalize. The aging demographics was pretty visible. Again, COVID sort of accelerated the retiring of baby boomers a little bit. Some people saying enough's enough, I'm going to retire now. Had enough of working during COVID. So it's accelerated that a little bit. But it's one of these ones when you have years of inflation being low and falling, which I'm just trying to find my chart at the beginning there. People become very complacent. We became complacent about energy supply in the last 5 years, but people become very ingrained in the belief that inflation can never come back until you get these shocks that we're seeing. And now that that's happened, it's sort of changed the ballpark a bit, and people have started to focus a little bit more on some of these inflationary drivers. So as usual, human beings are pretty good at extrapolating what they've seen for the last 10, 15, 20 years, but every 30, 40 years or something, some of these big long-term structural drivers will change, and it becomes a little bit of an adjustment process when it happens. The last sort of point on inflation is government policy has changed a little bit. For years, for decades, the governments didn't spend huge amounts on fiscal policy, but every time economy weakened, you would use monetary policy, which is lowering interest rates to stimulate the economies. That's what COVID kind of changed that as well, because we reopened that fiscal policy bucket, which was giving out free money and government support to populations. And now that we've done that, it's proving a little bit more difficult for governments to stop doing it. So the US is forgiving nearly $500 billion of student loans. Europe are now giving money to help populations deal with the high energy prices. So we do think that the government's role in, trying to give money to people to stop adverse outcome or pain is gonna be bigger going forward. And if you're constantly giving out government money to certain businesses or populations, then that will cause a little bit more inflation in higher goods. So this slide is just summarizing what we've just discussed, is that many of these factors have become less deflationary or more inflationary versus what they are. Technology is the only one that I do believe technology will continue to be deflationary, as it has been. Right. So, I mean, importantly is what does this mean? I'll go through this now and then I'll tackle a question once we get through these couple of slides. So if structural inflation does return, you tend to find you'll need slightly higher interest rates to keep that inflation at a reasonable level. So they won't really want policymakers around inflation running higher than 3%, or certainly over 3.5%. They'll want it somewhere around 2.5%, 3.5%. A bit of inflation is actually not a problem, but they're likely going to have to keep interest rates a little bit higher to do that. So it might be that mortgage rates need to stay, or mortgage rates may average 5% in New Zealand for the next decade rather than averaging 3.5%, 4%, which would be one of the implications. And that'll have implications for the price of housing and the price of other assets like equities and bonds. We do think you get shorter business cycles in periods of structural inflation versus structural deflation. And the bottom here is the US, the length in months of the business cycle expansions in the US over the last 170 years or so. So, in the pre-1900s period, expansions only lasted about 2 years or just over 20 months. And the post-war period up until 1990, the average business cycle was still only about 30 months or 2.5 years. So they weren't very long. Post-war to 1990, they were about 50 months. So just under 5 years. So they were decent cycles, but not really long. Since 1990, when inflation has been lower, we've seen a run of much longer business cycles. So, you've been running nearly 12 years in the recent cycle, 12 years in the lead up to the dot-com bubble in 2000. Up until the housing crisis, we still had a good 6-year cycle. So you've averaged nearly 10-year business cycles since 1990. And you can do that because normally what happens in a business cycle is the economy improves and heats up, inflation comes, and policymakers raise interest rate, and that kills the business cycle. And that's what used to happen back in the 1940s, 50s, 60s. When these little and structural inflation pressures, it takes a long time for inflation to appear, and that allows the business cycle to run a lot longer before interest rates need to go up to ruin that business cycle. So we think we're going back to more of a period where we have raised interest rates around the world now. We think eventually that'll bring inflation down to a reasonable level, 3% or so. It'll probably cause economic weakness, maybe even recessions in certain countries. As it does that, policymakers will then drop interest rates, and we will then begin an economic recovery. The housing market will recover, and share prices will recover. But we think inflation comes back quicker in the next cycle, which means we very quickly move back to raising interest rates again. And you just get these shorter boom bust cycles, means you get a little bit more ups and downs and probably housing prices and in share markets. And unfortunately, it probably means that the returns in housing and even in equities will be a bit lower over the next decade or so. If we're correct in our predictions here, will be a little bit lower than the returns we saw over the last 10 years or the last 20 years. And that means that getting good advice and active management and investments, we think is going to be very important. Stock picking within equities, having managers that and investment advice who are willing to say that it's time to be more cautious or time to have more of a go, we think will be more important going forward than what it was for the last decade. So there'll still be positive returns. So investing for a long term is always a very good idea. So we believe that we will get positive returns going forward, but to get very good returns, we think active management of investments will be more important. For housing, I've just said that interest rates and housing cycle will be shorter. We think house price growth, we're correcting in house prices now. We're down 16% in Auckland. We don't know how far it'll go. I mean, it'll go more than 20% down. You may even go another 15% and find that house prices pull back 30%, which would be, a big shock, but it's coming off a very big boom. For most people, that's not going to be, it's a little bit of a shame, but it's not the end of the world, given most people bought their house prices far lower. But you could see a correction, up to 20, 25, 30%. But, after that, we'll get a normal good recovery, because I think interest rates will be able to come down temporarily. And once we settle in after that period, we do think that the house price growth is more likely to follow wage growth. And as I said earlier, I think that the wage price growth, given labour supply, is going to be shorter. We expect to see more wage growth, more like 3 to 4% per annum, rather than the 2% per annum we're seeing since 1990. So, if that's correct, we think you get to a point then house prices just continue to rise higher, but more at the 4% per annum level, rather than the sort of 7% per annum level that we're seeing since 1991. So, housing will still be a very good asset class, but, maybe not quite as good as the big booms we've had in the last 30 years, but a very prudent investment and decision to buy for any young person looking to build up their assets. So that's sort of my structural inflation piece, and I was going to move onto some other topics and more looking at the current environment and what Milford's investing in. But should we answer a question from Ben now, Jack, before we do it? Do you want to read that one out, or otherwise I can? You might be on mute there, Jack, still.
Here we go. Technology, I tell you. Obviously not the baby boomer. So the question was from Ben around that he thinks there's going to be less productive workflows replacing the baby boomers, basically talking about himself there, which is quite and combined with historical lows and negative yielding fixed income, how are basically the corporate pension funds going to continue to wash their face in this environment? And is the pension funds a potential financial crisis in the making?
Yeah, he touches on a very good point there, because I think it does become more challenging. I mean, these pension funds have benefited, like all savings, and a very big boom over the previous period. And we did actually, I was discussing this with colleagues the other day, this slide, and someone said we need to put productivity in here as well as another factor. And I think we will be putting that productive point in there, because we do believe that the new workforce won't be quite as productive as the very experienced retiring baby boom workforce as well. So I agree. Is there a pension crisis? I think certain pension funds around the world will have a little bit of a problem. Some of the ones in Australia that we see, they have massive amounts of investments and unlisted or private investments, we think, that are valued incorrectly, and that will cause a problem. We wonder whether governments will begin to tap that big savings pool to reduce their cost of borrowing. So governments can say, pension funds, I want you to invest 10% of your entire savings pool and our government's bonds at a low return of 2%, because I need that low government. We're the New Zealand government, and we've got heaps of money we need to spend on this and spend on that, and we can't afford it. So we're going to make you guys give us some money at a cheap rate. So all these things are possibilities down the track. So there's going to be some challenges there. That the general thing is that I think in New Zealand, it's certainly where we're looking, is I think KiwiSaver and even the New Zealand Super Fund and so on. And I think our pension funds are reasonably robust and not going to suffer too many problems. It's certain of the older school pension funds in the US and parts of the UK and so on that have probably got a bigger challenge.
There's a question coming off to the side in another channel, which is they mentioned that you were talking about the government needing to do more policy-wise to get inflation under control. Do you think that's going to be effective in New Zealand during an election year, or will we need to rely on the other factors that you mentioned? No,
that's right. No, sorry, yeah. I might not have worded myself clearly, but government should, I think governments are doing the opposite. Their policy at the moment is not bringing inflation under control; it's making it worse. And I think I expect to continue to see that. New Zealand gave out another $300 per person to 2 million people. Europe's now giving out thousands of dollars to people. We expect government to continue to incrementally be inflationary. Election years, just the nature of politics, meaning that it's always going to be popular for votes to give money away to be re-elected. Biden has got his midterm elections in the US in a month and a half, and part of the student debt forgiveness and all sorts of things are all aimed at getting re-elected. So no, we think that it's going to be the monetary policy authorities, which is the central bankers at the Reserve Bank of New Zealand and the Fed Reserve in the US, have got a real headache on their hands, and that the government are certainly not helping them to bring inflation down.
Yeah. There's just one thing I just did want to correct you on. You mentioned that there's wage inflation in New Zealand. Obviously, our admin team's on the call. So Will's wrong. There is no wage inflation. Don't worry about that. Just ignore that discussion.
We had similar arguments in my job as well, where we didn't quite think that the inflation wage adjustments were quite fair inflation adjustments.
Yeah, I'm sure everybody's having that discussion at the moment. So you mentioned that there were some potentially good asset classes. One of the ones that I'm curious about, and I don't know if you've got the data to allow you to comment on it, but direct commercial property is one that I'm watching at the moment with quite a bit of interest, because the yields for any properties that do sell, which are very few, are staying quite low at about 4.5% yield, when the New Zealand 10-year government bonds obviously shot up dramatically. Do you have any comment on the direct commercial property space in New Zealand?
If we take a global view, we think you've got to be really careful with office. We just had a colleague over in the US visiting a lot of businesses there and looking at the office space, and particularly in the US, but there's a huge reluctance of people to turn to the office. So I think office is this whole work from home, the impact on office rents, the impact on office valuation is real. That that may not be as big an impact in regional commercial office buildings as opposed to CBD, but that's one thing I'll just be wary of when it comes to office space. But industrial property, if we're right about deglobalization and having to build more manufactories and supply chains back in the Western world, there's going to be big demand for industrial land. So industrial land's been doing pretty well anyway, but there probably is more structural tailwinds, which makes that an interesting asset class to look at. There's a reset underway this year in the valuations of everything. Residential house prices, the valuations of bonds, which have been selling off, equities have come down, and likely the valuations and even commercial assets are coming down a little bit, just as you point out. In a lot of cases, the bond yields are higher than property yields, and normally that'll mean the valuations on property come down, commercial property come down a bit as well. So there's a bit of a reset underway. But beyond that, commercial property and property is a good inflation hedge. So if there's structural inflation, it will generally hold its value in real terms over the period of time. So it's an interesting asset class to look at as you go into this downturn we're going through at the moment, particularly industrial.
I've got to do another couple of questions, but I'll let you push on with your key indicator slides because I think you're going to get to it when you start talking about portfolio positioning as well.
Great. Yeah, no, we'll go through this. So this is more of an update on what's actually happening here and now in markets than the big picture. So S&P 500, the leading US index, is down 18% year to date. Plenty of good bounces under the way. We had a 20% bounce beginning in June. So, but the trend at the moment has continued to go down. The ASX 200's fared better. It's only down 6% year to date. Has a lot of commodities and energy and some of these goods that have been high demand that have helped that index hold up better than the New Zealand index, which is down 11% year to date, and it also didn't do so well over the previous year before that. So when we talk on equity markets, we think you're probably through a decent chunk of this reset there. There's more to go. We're not on the clear yet. We like to use the eye of the storm environment where we went through the first half of the storm. We had a big recovery in the eye of the storm here, and markets really recovered. We think you've got to just get through this next little period. So that's why we're playing it pretty safe. But with our investments, we're keeping pretty low risk in there. And then you come out of it and you get into good times again where there's money to be made. So our job at the moment is just to weather the storm. We don't think we're quite through it, but it's just, the good news is we're a decent way through it. It's not like it's, we're right at the beginning. The decline in these share markets has been entirely driven by the valuations of companies we invest in going down. So this is the S&P 500, how it trades as the multiple of the profits or the earnings of the companies. Companies used to be valued at 23 times their profits, and they're now only valued at about 16.5 times their profits. So that entire decline has been driven by people paying less for the companies that they're investing in, mainly because interest rates have gone up. Earnings, this is the earnings of the S&P 500. Earnings are still at very elevated levels, so really boomed out of COVID. They're 25% above trend levels. We do think those earnings actually will come back, and that's why we say when we say we've gone through the eye of the storm and there's a second half of that storm to get through, we think that second half of the storm is more driven by the earnings coming back to more reasonable levels. And when that normalizes, you've weathered the storm and it's time to be more aggressive in your investments. So in our view anyway. A little update on the job markets. Job markets generally around the world remain very strong. This is the new job ads on a monthly basis in the US. They're adding 300,000 workers a month still, which is still at or above the highs of the last decade. So where you still have a very tight labor market in the US, which means wages are likely to continue going up at a reasonable rate, and that'll support that inflation. And this is the month-to-month inflation data in the US. So what we want to see for interest rates to at least stop rising or interest rates to go down is we want month-to-month inflation to be at 0.2% or lower, which is this red line here. And because 0.2, if your prices go up 0.2% every month, then you're only going up at about 2.5% a year, and then that's a low enough level of inflation that central banks could lower interest rates again, and then we all have a big party in New Zealand and buy houses again, and house prices go up. And New Zealand is of any country in the world some of the fastest to buy housing when interest rates go down, because we understand how much money can be made very quickly. So unfortunately at the moment, we've got two charts there. Headline inflation in the blue, which includes energy and food prices, and we have what we call the core inflation in the orange, which is everything else except energy prices and food prices. So oil prices have come back in the last couple of months, and petrol prices come down, which is why that headline level, the blue bars, there's almost no inflation. So that's a good start. The problem is outside of that, inflation continues to run at this 0.5% month-to-month level, which is far, far too high. and the central bankers in the world are going to want to see this orange bar of to also get down towards 0.2%. So we're not yet at the point where interest rates can be cut instead of raised. We may be there in 3 or 6 months. I think we'll probably be close to it in 6 to 9 months. I'll be surprised if we weren't, but for the time being, they're going to remain, unfortunately, hiking those interest rates, which will continue to won't give us a little bit of a reprieve on the valuations of houses and shares and bonds included as well. So at Milford, what do we do to invest in this? Well, just basics. Milford loves stock picking, and we love founder-led companies. So this isn't related to all the macroeconomic stuff I've just been talking about, but we believe that companies owned by founders tend to outperform, and they tend to outperform because those founders and those businesses tend to have a longer term mindset. They're not just some CEO helicoptered into a role to make money for 5 years and move on to the next job. They own a lot of the company, but the third point, which is soul in the game, is very important. They're passionate about their business and they're loyal to their business, and they really, really love it. So we've often had a third of our portfolio in these founder-led businesses, and as some of our Milford funds, this is the Milford Dynamic Fund, and the orange is the return of companies we own that are run by their founders, and in the grey is companies that weren't run by their founders. So we've had far better performance in the ones run by founders. So a little bit of basics and part of our philosophy, but we like getting out there and meeting companies and finding the best one that we particularly like it when we can find a good company that's still run by the founders. This is how we break down our portfolio. So this is, again, the Milford Dynamic Fund and invests in Australia, one of the ones I co-manage. The two bottom categories are what we call quality companies, which are very good, robust, staple type businesses like Fisher and Paykel Healthcare in New Zealand, or we call Spark New Zealand, and income companies. So income companies are the dividend generators. Contact Energy's one of the big ones we own, or Spark New Zealand. They tend to be your safer businesses. So we've increased over the year and had bigger weightings in these businesses than what we had in the bull market days of 2021. And what we've reduced is some of our cyclical companies, which tend to be more economically sensitive, and our growth companies, which are the growth companies are more like your Xero or your Microsoft and Amazons or Rocket Labs and all these technology companies that traded at very expensive valuations. The growth companies tend to suffer a little bit when interest rates go up and valuations come down. They tend to suffer much more. So we've kept our portfolio safer. The cyclical companies we do own, a lot of it has been focused in the energy space and has done very well in certain other commodities like lithium and copper, which are part of the green revolution. So we have done pretty well in these cyclical companies we have owned. And we've simply just held a little bit more cash or money at the bank. So we've left nearly 20% of the fund just sitting in the bank in term deposits or cash accounts earning a small interest rate. And we aim to deploy that money as we go through the second half of the storm we talk about over the next 6 months. We'll be looking to spend that 20% we have in cash on hopefully what we get at bargains and buying very good businesses at very good valuations. So this is just how we're thinking, is to keep the hard hats on and weather the next 6 months still. The best performing company we've had in our portfolio, certainly our Australian focused portfolios this year, is Neuron Pharmaceuticals. So Neuron is a biotech company. They have come up with a cure or a very good treatment for Rett syndrome. And Rett syndrome is a genetic disorder that appears pretty early on in young kids. Basically, these young children are just lacking an enzyme in their brain that gets rid of waste. And given you don't have that enzyme, as that waste accumulates in your brain, by the time they're 3 years old, enough of it accumulates and the kid gets old enough, you realize that there's something going wrong with the child, and that they effectively become impaired in their physical and cognitive functions because this waste in their brain interferes with their motor skills and their learning development. But there's nothing actually wrong with the kids as long as they didn't have that waste accumulating, or they could get rid of it. So Neuron Pharmaceutical is the first company in the world to come up with a leading treatment of it. They've given this basically an artificial enzyme. The drug just replaces its enzyme they're missing and begins to help removing this waste. And the trials that they've done on children between the age of 10 to 20 have been are very successful, and caused huge improvements in the ability of those children. And they'll soon begin trialing giving that treatment to younger and younger children, hopefully giving it to 3-year-olds when they're detected. And with the theory that if you can begin these treatments on kids when they're only 3 or 4, that they don't accumulate this waste, and they hopefully develop very closely like an ordinary child. So it only became apparent in December 21. They had the successful trial result, which is a phase 3 trial, which is a final trial you need to do before approval in the US, and that's why the share price jumped up from $1.50 to $4 a share. Milford owns over 5% of this company, and has continued to do well, and they're going to have approval for this treatment sometime early next year. It's 95. So at the moment, the drug isn't on sale to the public. It's got to be approved by the FDA, which is the leading regulator in the US for drug approvals. We think they're 95% likely to approve it, given there's not too many bad side effects of this drug, but there's always a risk they don't. If the FDA, for whatever reason, don't approve it, this share price will go down at a cliff back down to 50 or 30 or 20 cents. So I'm always wary when we talk about a company like this to investors is don't rush out there and buy a load of shares in Neuron Pharmaceutical, because these things can go wrong. And when you're investing in businesses like this, you only ever invest largely what you're happy to lose. Milford, for example, has about 1 to 1% of our portfolios in this business. That is mostly profit that we've made now, because their position was much smaller, less than 1% of our portfolios back in 2021, and has grown to a bigger position over time. But we sell and take a few profits, and when these share prices run up. But it is an exciting company. If the drug is approved, and there's a number of other similar drugs coming for similar genetic disorders over the next couple of years, and this share price certainly could continue to go a lot higher. So it's been a very good investment for us, and it's always great having an investment that's doing fantastic things for a lot of these families and children over here who suffer from this disease. So certainly pulls on the heartstrings on this one. And then on the opposite side, a company that some people say doesn't do a good thing for society is the fatty fried chicken and chips. But Milford actually has been a shareholder in Collins Food, which runs the KFCs over in Australia. Restaurant Brands, of course, is the company in New Zealand on the NZX to those KFC New Zealand. Brian Gaynor, our late founder, bought a lot of Restaurant Brands shares for Milford and our clients back in 2008 and 2009 during the recession at that time. And of course, KFC actually is pretty cheap. And when economic times are tough, people eat it less out at restaurants, and they might buy a cheaper bucket of chicken. And we're seeing a similar dynamic now as the economy slows over the moment in Australia, is that KFC is still fairly affordable, and we think people will increasingly buy cheaper takeaways. And we think that Collins Food over in Australia is a reasonably good investment over the next couple of years. So we have been increasing our position in that company.
Just before you jump onto the next slide, we're probably a couple of minutes away from finishing up. So if anyone does have a question, now would be a good time to be typing it into the Q&A section. And I'll just hand back to you to talk about the Absolute Growth Fund.
That's the end. This is just our performance chart. So we, 2% over the last year in this Absolute Growth Fund. We've done about 10% since inception. And the Dynamic Fund, which is a bit more risk taking, has done 12%. But I'll leave it there. Really, so we can cover off any questions that come up, or if you've got any questions yourself, Jack.
No, there's no questions come up from my side. Just checking the other channel. All those questions have been covered off. I think everything's been covered off here, Will, and I got to say it was a very surprising presentation. I was expecting more of the macro, the later part of the presentation, but the initial part was very interesting, and I know we're going to get a lot of feedback from clients on this.
No, it's a big topic, and Milford's been doing a lot of work on it recently because it is. We suspect you are at those paradigm shift points. These paradigm shifts don't happen every year or 5 years or even every 10 years. They may happen over once every 30, 40 years, you know.
Mm.
And when China came onto the world and the baby boomers came of age in 1980, that was a paradigm shift. And we think you're going through the reverse now, and it's going to be navigating through this. If you can discover these trends and then invest wisely on the context of these trends, then you can get through the next 10, 20 years in a far better position than if you blindly are caught out by it.
Yeah, I certainly think now has been a good example on why we need to focus on protecting the capital as opposed to getting gains on the capital. You've got to actually have some capital left to participate in the upside. So I just to finish off, I'd just like to thank you for making your time to present to us today. I know you're very busy. And also thank you to everybody on the call from the PWA team. I won't name us all this time because the team's getting a bit big. But thanks to everybody for making the time to come in. And if you do have any questions that you didn't get to ask on this call, please feel free to fire them through to myself or your advisor, and we'll get the answer from Will. Thank you very much.
Great. Thanks, Jack, and thanks everyone. See you.